the Trump agenda. President Trump set to have lunch with Republican senators today to talk about key issues facing lawmakers ahead of the midterms, from North Korea to the nomination of Gina Haspel as CIA director. As the midterms approach, however, lawmakers want to highlight the success of this administration, including economic growth, deregulation, and tax reform. Since the 2016 election, markets are up at least 25%. The Dow is up 35%. The S&P is up 26%. And the NASDAQ is up 42% since Election Day. Joining us now is ETF Trends CEO Tom Lydon. Tom, it's good to see you.
Great seeing you, Maria.
What's going on in the ETF world these days?
Well, a lot of flows keep coming in, $128 billion so far this year. But the first time forever, we've seen more flows going into international equities. They've been unloved so far in the U.S. in the last 5 years, but the valuations are there. Even though we're at a 16.5% PE here in the U.S., overseas, developed nations, 14, and in emerging markets, 12. So it's cheap. We're starting to get some spread over in those areas. Great valuations. The trends are surely in place.
We keep hearing more about emerging markets. That's where much of the money is going.
Well, it is. And, you know, the key is when you look at some of the key people out there that have a finger on the pulse, it's really key and important to make sure you diversify your portfolio. A lot of people just have the S&P 500 in the portfolio, and that's not going to cut it.
Well, so emerging markets have looked a little shaky lately. We have Argentina going to the IMF for standby lending. We have countries like Turkey and South Africa looking a little wobbly as the dollar strengthens. Is this the right time to be going into emerging markets?
So you're always going to be able to pick out some of the weak spots, number one. Number two, oil, dollar increasing, not necessarily great. But if you look at areas like China, for example, the news that came out about these A shares that are going to be in the MSCI emerging market index.
Yeah, the MSCI adding 200 Chinese stocks to that index.
Yeah. Right.
It's going to open the door to more investment in China.
It absolutely is. But the key is it's just the tip of the iceberg. These 234 stocks are only going to represent 0.4% of the MSCI Emerging Market Index. Over the next few years, it'll be 5%. But if up until this point, if you want to get into China, you had to buy via Hong Kong. Now, A shares are going to be something that we here in the U.S. are going to have more accessible. There's two of the biggest Chinese banks are going to be in the index now for the first time.
Big development.
Yeah.
I'm talking about the U.S. market. We were talking earlier, you know, last year we saw a high of like 26.5 in the Dow.
Yeah.
Heavy volatility now. The highs are not covering the aggregate lows.
Right.
So are we better off? What are you telling the people? Getting into the 10-year Treasury at 3% for the balance of the year?
I think what you have to do is, if you look at the trend, if you look at the 200-day average, just the simple 200-day average, it served you really well. The correction that we saw in February and March came down for the NASDAQ and for the S&P, touched on the average, has rebounded since. The trend is your friend, and I think long-term, if investors are going to make it into retirement, they need to be there for the long term. Yeah, the Treasury with hitting that magic 3% number, for some people, that might be a little bit scary. Long term, though, we're going to see higher interest rates for sure. I think we're all built up for that, definitely.
So you're still putting money into U.S. stocks then?
U.S. stocks, but don't forget foreign markets, and most importantly, this MSCI Emerging Market Index, you can buy that for 0.14% expense ratio with the iShares Emerging Market Growth Index. I mean, today, compared to just 5 years ago where you would have spent 1%, it's amazing that you can get that type of diversification.
The old saying was sell in May and go away. Is that going to hold up this year? We've had a pretty good run.
We've had a pretty good run, but with 3 out of 4 companies beating expectations here in the U.S. and 2 out of 3 overseas, again, trends in place. Make sure, you know, if you try to second guess the market, it always comes to bite you, right?
But that's what's important is corporations are outperforming. They're doing a great job, right?
Yes.
And yet it's not having that same impact on the equities market.
No, it's not 1999, Bob, right?
Yeah.
Well, it's not even 2017. We had a great year last year, by the way, guys.
We're exactly. Yeah. Well, that's it. And all I can say is when you look at the general flows and the amount of money, now we're at $3.7 trillion that have gone into ETFs. It's amazing to see the diversification that's out there. And more money's just coming in. Again, at one point in time, we're going to have major corrections for sure. We've had a 9-year bull market in stocks, 30-year bull market in bonds. But from a trend-following standpoint, and I think that's what it's all about, you got to stick with it.
Well, how serious are the risks out there? I mean, when you look at inflation, John, when you look at the possibility that the Federal Reserve continues raising interest rates this year and going into next year, are these the fundamental risks that we need to watch out for, or is there something else that could change the backdrop, which is quite positive, 26% earnings growth in the first
quarter? I think the Fed certainly is a risk this year. It doesn't look like a big one because the argument is mostly, you know, did they do 4 interest rate increases instead of 3? That doesn't sound like a very big deal, but the risk is that the Fed is going to do more than the market is pricing in. Right. So I think that is a potential problem.
But we've had times before where we've had rising rates. The economy's been operating very well, and the market's done fine, too. So can we have a 10-year Treasury that's at 4.5% and still do well?
But in modern history, we have not had a Federal Reserve with a balance sheet the size it is that executed unprecedented monetary policy, and investors are standing around acting like there's not going to be any problem as they wind this down because they've, quote, telegraphed it well, which is just hogwash.
I think the bigger risk is a year or two out when, you know, the Fed is by then raised interest rates quite a bit, but we also have a lot of the fiscal stimulus that's put in place starting to unwind, and we start to look at potentially some of the tax cuts that we've gotten being reversed and replaced by what was in place last year. So we did. The Journal did a survey of Wall Street economists asking when's the next recession. The consensus was 2020. You know, so it looks like the next year and a half.
That's definitely the feeling that things slow down quite a bit going into 2020, Dagan.
Right. That's what Bob Kaplan told you.
Absolutely.
That you really see the market impact next year. But the overarching worries, which do go to the bottom lines of inflation and earnings, would be North Korea, what's happening there, with China, those are, and Iran, because those are all linked with one another. And you see what's happening with the shadow war between Israel and Iran and Syria. There are a lot of geopolitical problems, and that could, again, oil prices skyrocketing, tariffs, increased prices for U.S. consumers and businesses. So it's all, and then
these are all real risks.
NAFTA by the end of the week.
Absolutely.
We're waiting on a deal on NAFTA. We could be getting good news. I mean, what a great risk to take off the table if we come up with some kind of agreement to denuclearize the Korean.
That's
one
totally
more question. Yeah. So prevent defense here, right? So we had a great 2017, as Maria said. I don't want to write it down. Right. How do I protect it? Where do I go?
So we talked about trends. A real simple tool that investors can use is just use a 200-day moving average. If you put a 200-day average on the S&P, and if we break that critical point, if you take a third of your equity portfolio off and put it on the sidelines, historically, that's been a great tool.
Okay.
All right.
And where are we relative to the 200-day average?
We're about 6% above the 200-day average on the S&P right now. Yeah.
So you think it comes in then?
Yeah, well, at one point in time, if that does happen, if all these things come to pass in 2020, we're going to break that average before we hit the recession.
I gotcha. All right, Tom, great to see you.
Thanks so much.
You, folks.
Thank you.
Great insights. Tom Lydon joining us there.